Smart ways to save tax without locking your money in investments. PPF, NPS, ELSS, Bank Tax Saver FD, and ULIPs are some of the common ways to save tax through investment. But what if you don't want to invest and lock in your hard-earned money? Well, there are still other ways to save income tax without investing your money. Tax-saving ways without investment. 1. Insurance premium. Your life and health insurance premiums can be claimed as tax deductions under Sections 80C and 80D, respectively. The limits to claim a tax deduction under Section 80D depend on who is included under the health insurance cover and their age. Hence, depending on the taxpayer's family members, such as spouses, parents, and children for whom the insurance is taken, the limit could be between 25,000 rupees and 1 lakh rupees. For life insurance premiums, the limit is up to 1.5 lakh rupees under Section 80C. 2. Children's tuition fee and hostel allowance. According to Section 80C, you can claim a deduction of the tuition you pay for your children, maximum of 2, to any educational institute. However, the limit is Rs. 150,000. Other than that, according to Section 1014, you are exempt from paying taxes for special allowances given by employers for the education of your children, which might include hostel expenditures. 3. Education loan repayment. Many of us who begin earning after finishing our higher education tend to have the burden of repaying our education loans (EMIs). While you manage your finances in the early stages of your career, do not miss out on availing of the tax benefit on an education loan if you fall into the taxable income bracket. The interest component of your education loan, any repayment can be claimed as a tax benefit under Section 80E of the Income Tax Act. This tax benefit can be claimed by either the parent or the child, student, depending on who repays the education loan. 4. Home loan repayment. While you repay the home loan EMIs, remember that the principal component is eligible for tax deduction under Section 80C. As far as the interest component is concerned, home loan borrowers can claim a tax deduction under Section 24 of the Income Tax. The maximum tax deduction that a taxpayer can get here on the interest payment of a home loan taken for a self-occupied property is 2 lakh rupees. 5. Deduction on rent for those not receiving HRA. While most of us know that employees receiving HRA can claim a tax deduction on the rent paid by them under Section 1013A. Do you know that even those living in rental accommodation, but not receiving HRA as a part of their salaries, or non-salaried people living in rented accommodation can claim a deduction for their rent expense under Section 80GG of the Income Tax Act. 6. Interest paid for loans taken to purchase e-vehicles. Given the environmental benefits of EVs, the government has been encouraging citizens to buy an electric vehicle. One of the steps taken by the government towards its vision of making electric vehicles, EVs, affordable to consumers, and making it an additional incentive for people to buy them is by providing a deduction of up to 1.5 lakh rupees per year under Section 80E for interest payable on loans availed to purchase EVs. The individual taxpayer may have an electric vehicle for personal or business use. To avail of this deduction, the loan must be taken between April 1st and March 31st, 2023. 7. Interest earned from a savings account. More often than not, taxpayers are unaware of this benefit available under Section 80 TTA. This section makes interest income of up to 10,000 rupees PA earned from savings accounts tax-free, beyond which the interest income becomes taxable as per the tax slab of the depositor. 8. Disabled dependents' medical expenses. If, as a taxpayer, you are looking after disabled dependents, you can claim a tax deduction on expenses under Section 80 DD. This deduction is offered to help taxpayers take care of their disabled family members who are dependent on them. A taxpayer can claim a tax deduction up to 75,000 in a financial year if the dependent person has at least 40% of any of the specified disabilities. A taxpayer can claim a tax deduction up to 1.25 lakh in a financial year if the dependent person has at least 80% of any of the specified disabilities, which are considered to be severe disabilities.